Tesla is currently trading at $173 a share and is up almost 5% a day off some news. This is from Reuters stating that Tesla was going to scrap its low-cost car plans. And then earlier today, Elon Musk had a retort and denied that this is the case on X, formerly known as Twitter. So what we're going to be doing today is looking at my automated stock valuation spreadsheet, looking at the company's financials, then giving a fair value based on discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value to see if Tesla is a buy or a sell. Now, before we just get in the news, let's have a quick look at the stock price. Yes, up almost 5% today at $173 a share. But if we take this out a little bit further and have a look over the last, year to date, it is down almost 30%, down from $250 a share. If we go back over the last 5 years, the stock was in the pandemic a $34 stock. Was a $34 stock, rose over 1,000% to its highs at around about 380 and is down 57 since then. So this stock was, I believe, the third largest in the world at one point and has dropped down a little bit more, but it is still the largest automaker in the world with a market cap of around about 550. Toyota is, to be fair, it's a closer second than what I thought it was, but you can see 330 billion in market cap, then Porsche, Mercedes-Benz, and all the way down to the next American car maker is Ford and GM with 50 billion apiece. So it is easily the largest automaker by market cap, but Toyota is closing in. So let's have a quick look at these the news here. So basically what Reuters said is that the entry-level Tesla car won't be built. This was inside sources that told Reuters, and they were going to focus on the self-driving taxis, which will be have their first reveal in August 8th of this year. Basically, there's the push from Musk, Tesla, Robotaxi unveil 8.8, sending the shares back up after trading. The stock price did have a bit of a bump of this, as you can see here on that day, but because of this Reuters article, it dropped back down, and then basically Musk had a response basically saying that Reuters is lying, very short and to the point. But enough about this. Let's go into my sheet and let's have a look at Tesla. So if I type in Tesla, this will load up all the company financials. And we can see here, we'll basically have a little view here of everything that it is, but we'll do a deeper dive. Price 137, market cap 550 billion, PE ratio of 40, which is on the higher side. Average is about 28. Earnings per share $4.30, a beta of 2.4, meaning it is a lot more volatile than the market. Target price of 190. So let's have a look at the revenue numbers here, and these are the revenue numbers basically going back as far as we can. 2021, and this company has had very large revenue growth, maybe slowing down in the last year. As you can see here, basically it almost doubled in 21 to 22 over the last 5 years. 35% compound annual growth rate. So it has been a revenue generating monster and has been growing quite substantially, but obviously in recent times it has slowed a little bit, which is why the stock has had a cause for concern. Net income, this is profit, and yes, Tesla are profitable. Ignore this number here, it doesn't like the fact it's gone from a negative to a positive. I will try and fix that. But we can see that the company was not profitable up until 21, 5 billion, more than doubled to 12 billion, and increased again to 15 billion, but only 4 years of positive data there, so it's hard to really say what we're going to expect. But I suppose the difference between 1 billion to 5 billion and 5 billion to 12 is good growth, and then 13 to 15, not as much. Shares outstanding chart, I'll skip by this because of the way that the data I use for this company to get the company data doesn't really handle the stock splits too well. You can see here that basically it looks like they've issued a lot more shares, but we'll skip past this. This is the assets versus liabilities. You can see assets has finally overtaken liabilities, which is excellent news. And then free cash flow. free cash flow is currently at 4.36 billion, down from the prior in 2022. They can use free cash flow to grow the company, pay dividends, buy back shares, things like that. So hopefully all free cash flow is used in the growth of Tesla. So let's have a look at the valuation. This is a discounted free cash flow model. Looks at uses a way of valuing companies using its estimated future free cash flows, discounting them to today's value and giving a fair valuation of the company. I do not think it'll like this, and no, minus 71. So immediately there is problems. So let's have a look and see why this is the case. The reason for this is it's taking some averages based on the net income to free cash flow. So we'll just quickly put in the 2023 number and see what that gives us. Oh yes, there you go. It's now a positive share price, $20 a share. So if we look at revenue estimates, yes, you can see revenue has slowed. Let's have a look at what analysts are saying in terms of the next few years. 5 years, 14% growth per annum. So let's that is less bullish than what we're saying based off the averages. And then net income margins, once again, all over the place. I think I'll take an average of these numbers here, which is about 19%. So discount free cash flow, I didn't think it was going to like this, and it puts it at a $23 stock, which would be less than, I believe, Toyota and Porsche and BMW, definitely those. So now we're going to look at the comparable companies model. This is a way of comparing companies using similar metrics to compare. The ones that we're looking at is EBITDA, which is earnings before interest, taxes, depreciation, amortization. PEG, which is the Peter Lynch popularized formula, which is price to earnings growth. One fairly valued, less than one is undervalued, and more than one is overvalued. And then other things, EV to revenue, EV to EBITDA, and PE. So let's put in some companies here. I'm going to go with the American companies first. I'm also going to add Toyota, which is ticker TM. The quick problem with Toyota though, and this is true on a lot of websites and even the one where I'm using to get the data from, it is in a combination of Japanese yen and dollars. So you can see here the equity value is 324 billion, whereas the revenue here is in yen. So I'm going to do a rough calculation. I believe USD to yen is about $1 to 150 yen. So I'm just going to quickly divide all these by 150 and we'll see how this looks. And then I'll compare against GM and Ford based on these. So yes, the enterprise value is 3 billion there. Let's just put in the value here. Okay, so revenues, we're looking at the revenues here. Revenues are a lot higher for GM and Ford and Toyota in the hundreds of billion, 170 to 290. The growth rate for Tesla, this is obviously the key figure here, 35% compared to the 3, 2, and 4.8% of Toyota. But Toyota is really showing that it is a good second place here, beating out GM and Ford. EBITDA, once again, all quite similar apart from Toyota. Net income, Tesla is second. So what they're doing with their revenue, they're more profitable. Profit margins 15%, 5, 2, and 10. So Toyota is probably the closest competitor here to see, but obviously it's not working too well because of the yen. But PEG ratio, in terms of undervalued, would only say that it is Ford Motor Company. Everything else is overvalued. So what we're looking here is lower multiples, and we can see it's kind of all over the place. Tesla, on compared to these other automakers, has a lot higher EV to EBITDA, PE value, and EV to revenue. So based on the comparable company model, it is probably overpriced by about 100% at $63 a share. So let me just quickly undo Toyota and let's go to here. And let's compare with GM, Ford more directly. And once again, this is going to be telling us a similar story. Actually brings it a bit closer, $80 stock, that if it was valued in the same way that GM and Ford are. So this is saying it is overvalued as well. And finally, the Ben Graham formula for intrinsic value. What this is looking at earnings per share, the growth rate of a no growth company of 7, AAA bond yield, and the corporate bond yield. If we have a look at the bond yield right now, it is still the same, 5.01. That's good. And well, we know that analysts are expecting around about 15% growth for Tesla, which would put it at about an $83 stock. For Tesla to be fairly valued. I thought this would be a bit higher. 40. Yeah, would have to have 40% growth rate over these next few years. So overall, Ben Graham is not saying to buy. So Ben Graham formula says it's not to buy. The comparable companies model says it's overpriced. And finally, free cash flow, discount free cash flow model says it's overpriced as well. Right, guys, thanks for watching. Please give a like on the video if you've enjoyed it. Subscribe if you're not subscribe if you're not already, and check out my Patreon, links in the description. I will be trying to be quicker to giving people who are subscribed my link. I was away on holiday over the weekend, and I believe a user has requested this, and I was a bit slow to get him the link, but I have messaged you, and hopefully you can see it now, and we can hopefully get you set up. I've also set up another user with this, but I am learning with this Patreon, so if there are any issues, give me time, and I will get them fixed immediately. Right, speak to you later. Bye.